Hey, everybody, welcome back, welcome back. Let me just get this disclaimer out of the way. Blah, 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 blah. Read it. Don't do what I tell you to do. Go and talk to a professional who spent 3 months as a getting their financial advisor license because they are highly qualified and I'm not. Anyway, okay, let's talk about this market correction. Okay, so going back to, if you go back and check my videos a little while ago, back here, I believe it was 821, I shouted out, we are going to have a market top around this area. Now, I might say, but you were wrong, Steve, and you would be right. But what I did say, if you listen very carefully, is that we might go a little bit higher, which we did, okay, and then ultimately we're going to have a correction. Now, one of the things I want to stress to retail traders, the difference between what I do as what you do as a retail trader, what I did as an institutional trader, is that um, we when you work in institutions, you're not thinking binary outcomes, meaning that it's black or it's white. It's never black or white. Okay, institutional traders are always building ideas, looking to the market to give them feedback, and then adjusting their ideas. So one of the things that retail traders do, they think today, right? So at this particular day, when I was looking at a top here, I had no idea that this uh, reporting, this earnings quarter was going to be this strong. I didn't know that. I had to guess, right? And so, in any event, the market did do what I said it was, which was go higher. Now, to be honest with you, it went a little bit higher than I really expected it to. And that was because the earnings quarter was so good. Really was an outstanding earnings quarter. But I still have my longer term leap positions on, and that's why I bought long term leaps. I have December puts that are finally making me some money, and there was a reason why I did that. Okay, I didn't just go and do I paid the extra premium for those long-term leaps for a reason because I knew it was going to take some time. I didn't really know what was going to happen during the earnings quarter, and now finally those puts are finally going to make some money. Now, I'm actually going to roll them out to probably I'm going to go out as far as February, sorry, uh, March, April, May of next year, right? Because I just think it's going to take that much longer. And now I've got profits, and now I can use my profits to roll them out. Okay. Now that being said, um, this earnings quarter was off the charts. I mean, it was really outstanding how well this earnings quarter was. And you know, do I think the market is going to have a correction? Yes, I am still long term bullish. But again, I want to just show you the difference between retail traders and institutional traders. Remember, retail traders are binary and they very rarely adjust. They just take an idea and they stick with it, and that's it. They're just attached to it. Institutional traders take an idea, they build a position, okay, that is congruent with their idea, and then again, what they do is they build a position. So, for example, when we started beating on all these earnings, I did not add to my trade, right? I did not add to my trade because it wouldn't have made sense because things changed from here to here, right? So now we've had this big move, and everybody on StockTwits is calling Armageddon, and we're going to crash. And it looks like this is approximately about a 5% move here. Now, can we go lower from here? Absolutely. But I'm going to roll out my puts, right? And because this was such a good earnings quarter, I'm not going to add to them just yet, right? I'm going to wait. I'm going to wait because in a couple more days, we have Alcoa that's going to be starting a new round of earnings, and the market is going to wait to see what's going on there. Now, I wish it was that simple this quarter. That's what I would do every quarter based upon, what my objective is, long or short. Now, this quarter, we have something that is very, very different, and that is we have the midterm elections. Now, I suggest you go and learn everything you can about these midterm elections that are coming up in less than 3 weeks from now, because they're going to make a big difference, and that is what's truly causing this volatility. It's not tariffs. It really isn't anything but this midterm election, because so much is going to depend. I mean, if the Republicans can continue to hold the Senate. It's the Senate, right? I always get the Senate and the House mixed up. That's why I suggest you go and learn about it. If the Republicans can continue to hold the Senate, House of Representatives, 35 seats of the Senate and the House, both of them. Right? It's very possible we could be seeing impeachment and all kinds of other crap going on that is going to cause all kinds of volatility, right? So I think this reaction isn't so much based on valuations right now. I think it's just based on the political uncertainty right now. But so we've got to really keep an eye on that, because if the Democrats are able to gain control, we are in for a world of volatility, and we could have a very large correction. We very, very well could have a good large correction. But again, I want to show you how I adjust, just so you understand it. So if we go back, to what I originally think the valuation of the market is, I think the valuation of the market is probably somewhere around 183. Okay? Now, where am I getting that from? I'm getting that from, just basically a lot of experience at watching valuations, okay, and watching how stocks deviate from valuations. That's what I think. But like I said, I stay flexible in my thinking. So when I see a blowout quarter like we had last earnings reporting season, I adjust it. So now I think my valuation is more like 200, right? Because everything got better, right? So I think true value is probably somewhere around 200. Now, so that's how I do it, right? I don't change my ideas, right? I just adjust and adapt my ideas to current situations, understanding that markets are forward-thinking mechanisms. Okay. Now the other thing that's really important is we have, a market or an economy that has $15.5 trillion in debt, and I think ultimately that debt is going to take its toll as interest rates rise. It's going to be harder and harder and harder, if not impossible, for the United States to pay all of the interest on all of the bonds that everybody has written in treasuries. Okay, it's going to become impossible because debt is cumulative, right? And if you don't know, Albert Einstein once said, the true eighth wonder of the world is compound interest, right? So, 2 points I want you to take away from this. Do I think this is a correction? It could be the start of a correction, but to me, it's just not enough evidence right now that we are going to have a major correction. However, there's some unknowns here. I think I think it could very well potentially be the start of the correction based upon the fact that if the Republicans can control the House, I don't think we're going to see the correction this time. If the Democrats do get control, we start talking impeachment, we start talking about 2020, because remember, even if Trump is impeached or whatever the heck goes on, really nothing can be done until 2020, right? I mean, because then you still have to win the election. So we're still a ways away from anything big happening, like repealing the tax cuts or whatever. Like, I don't really even know, but we're still a ways away, right? So could this be a correction? It very well could be. I am in long-term leaps, but I'm not building that position. As a matter of fact, short-term, I'm actually going to be, playing the swings and things. And in case you guys don't know, that's the way you want to do it. You want to have a long-term idea, right, and position yourself for that. So I'm actually going to roll my December leaps that I purchased are now in profit. I'm going to roll them out because I don't think there's enough time right now, and I want to go out another quarter because I want to see what's going to happen during this quarter, right? I mean, are we going to be off the charts again? What's going to happen in November? I want to buy myself more time, and there's uncertainty. So rather than just saying, oh my God, I'm going to hold on to my Decembers because we're going to crash, no. I'm going to roll them out because we're going into more uncertainty, right? Then what I'm going to do is play shorter term, like 1 week, 2 week options on the upside, downside, right? That I am just day trading more or less, okay? So I'm still bearish, right? I think that in my personal opinion, which is just based upon, it's really hard to say, guys, because, when you sit and watch the market for 40 years of your life, you just get a feel for it, right? I mean, it really is an art as much as it is a science. That's the one thing that when I teach my students, I teach them the right things to look for, but I can't give them the experience in order to really capitalize on it. My students make good money, but they don't make as much money as they could if they had the experience. And that's why I always, even when my students want to swing trade, I always insist that they day trade. And the reason why, and I insist they do it on a 1 minute chart. And the reason why I do that is because I want them to gain as much screen time in watching order flow in order to really have the experience, to make that experience exponentially fast. So again, I called the top here. It took a little bit longer. The quarter was really good. Instead of having a 180 target, I'm now having a 200 target. But again, it's longer term. And I'm not adding to that trade yet. Okay, I want to be clear on that. Okay? Retail traders are binary. They're in, they're out. And it's okay to be binary on short-term trades. I do it all the time. But institutional traders, they build positions. And I think there's going to be enough time for me to build this short position. I'm not completely convinced that we're going to have a major correction just yet. I could be totally wrong. And guess what? I'll only make $100,000, right? But so what? I'll make $100,000. I would prefer to be more confident in that, and I would prefer to build that position and for the market to do something like this, and I'll make $200,000, right? Let me just clear this out. So I'd prefer the market to do, this is what we're doing right now. Here's my target down here, and here's where we are right now. I'd prefer for the market to do something like this, and then when I have more certainty about the elections, when I have more certainty about the earnings this quarter, this is where I want to add to my trade. Right now it does that. This is where I want to add to my trade. Okay? When I have more certainty. That's ideally. Now, will I get these opportunities? Maybe not. Right? But I don't care. I'm still going to make $100,000. Right? But I'm going to do it in a safe way. I'm not going to do it like an idiot, all in, all out, right? Right? If this happens and I get it the way that I want it, okay, great. I make $400,000, right? but I'm making the money safely, right? And that's the difference. Retail traders are binary. Institutional traders, they are always building positions based upon factual evidence as they get it. And that's the problem with crashes. Crashes, you might not get those opportunities, right? I mean, you might not get. We could by the end of today, we could be down at 183. It's not impossible, right? But so what? I don't care. I'm doing it safely. There'll always be more opportunities. Okay? Stop thinking binary. Think build positions. Take a binary longer term direction, but then build your position. Thank you. Bye for now.